All right, let's jump right in. There's this really fascinating idea going around that Bitcoin's price isn't just moving up and down randomly. The theory is that it's being actively pushed down, like a coiled spring, just waiting. So today, we're going to unpack that. What is this pressure? And more importantly, what happens when it's finally released?
And look, this isn't just some random theory you'd find on Twitter. We're talking about Matt Hougan here, the CIO of Bitwise. He's the one saying this, and his point is, based on all the fundamentals, the price should probably be way higher than it is. But something is holding it back. And that's our central idea for today. Bitcoin as a compressed spring.
So that's the big question, right? If Bitcoin really is a coiled spring, what in the world is pressing down on it? To figure that out, we've got to peel back the layers and look at a hidden force, something deep inside the market's plumbing.
Okay, let's get into it. This isn't just about more people selling than buying. No, it's way more complex. We're talking about a very specific, kind of wonky structural thing in the crypto financial system that might be creating this artificial cap on the price.
And it's not just one person saying this. Here's Saylor, another huge voice in the space, basically saying the same thing. He says, nope, it's not about feelings or day-to-day trading. He flat out calls it a specific structural problem. And the core of this problem, he believes, is that it lets the same Bitcoin be sold over and over and over again in a way. So, how does that even work? Let's break it down. The magic word here, the heart of this structural problem, is a mouthful: rehypothecation. I know, it sounds super complicated, but the concept is actually pretty simple. Imagine you give a lender your asset, say your Bitcoin, as collateral for a loan, but then they turn around and use your Bitcoin for their own business. It's kind of like giving your car keys to a valet, and while you're inside eating dinner, he's out renting your car to someone else. That's the basic idea.
So here's how this loop actually plays out. Step 1, you deposit one real Bitcoin to get a loan. Easy enough. Step 2, the lender, instead of just locking it away safely, reuses your Bitcoin. They might lend it to someone else or use it for their own margin. And just like that, step 3, your one single physical Bitcoin has suddenly spawned multiple paper claims to it out in the market. And all those paper claims add to the total sellable supply.
Okay, let me put this another way. Think about your house. When you get a mortgage, can the bank go and sell your house to 10 other people at the same time? No way. That's obviously illegal. But in the kind of Wild West corners of the crypto world, something very similar has been going on with Bitcoin used as collateral. And all of that creates this constant, artificial downward pressure on the price.
Okay, so this rehypothecation thing definitely creates some downward pressure. But, and this is a big but, just calling it suppression might be a little too simple. A better way to think about it, a more accurate picture, is to see it as a volatility amplifier.
And this is where we have to make a really important distinction. You've got two kinds of supply. First, there's the actual supply. You know, the roughly 19 million Bitcoin that have actually been mined. That's it. But the market doesn't just trade on that. It trades on the economic supply. And that includes the real Bitcoin plus all those paper claims we talked about. The futures, the ETFs, and of course the rehypothecated stuff. And you can bet that economic supply is way, way bigger than the actual physical supply.
And this right here is the key insight. This whole structure, the rehypothecation and leverage, it doesn't just push the price down, it's an amplifier. Think about it. When the market's going down, yeah, it makes the selling worse. But when the market turns and starts going up, it can amplify the buying pressure like crazy, forcing all the short sellers to buy back and leading to those absolutely explosive moves to the upside. So you see, it really does cut both ways.
Okay, so if this whole market structure thing is more of an amplifier than the main engine, what is the main engine? What's the number one force that's actually driving the bus here and setting the price's direction? What's the big one we should all be keeping our eyes on?
Well, when you look at the data, the answer is surprisingly clear: global liquidity. It turns out Bitcoin's price correlates most strongly not with anything happening inside crypto, but with how much money is flowing through the entire global financial system. We're talking about things like the global M2 money supply, which is just a fancy way of measuring all the cash and easy-to-get money in an economy. The simple version? When there's a lot of cash sloshing around the world, assets like Bitcoin tend to do really, really well.
All right, so let's recap. We've got the spring, coiled up by all this market structure stuff. And we know the main force moving it is global liquidity. So the question is, what are the specific triggers? What are the events that could finally let that spring snap? Let's walk through 5 huge ones to keep on your radar.
But first, before we get to the triggers, we need to talk about just how incredibly tight the real Bitcoin supply is. I mean, think about this. About 20% of all Bitcoin is probably lost forever. Gone. Then you have another 65% held by long-term holders. These are people who almost never sell. So what does that leave? It leaves a tiny, tiny fraction, maybe only 15%, that's actually liquid and available to trade. Just keep that number, 15%, in the back of your head as we talk about these triggers.
Okay, trigger number 1. This is the big one, and it goes right back to what we just talked about, global liquidity. The second that central banks, especially the US Fed, signal they're done tightening and are ready to start expanding the money supply again, cutting interest rates, that's the green light. That could kick off a whole new structural bull run.
Trigger number 2 could be an absolute game changer, sovereign adoption. And no, we're not just talking about El Salvador anymore. Picture this, a major nation, maybe a Singapore or a UAE, publicly announces they're putting Bitcoin on their balance sheet, into their national reserves. What happens then? Well, the game theory just goes into overdrive. Every other country has to sit up and ask, should we be doing that too? It could set off a global scramble.
Next up, trigger number 3, a good old-fashioned supply shock. And this is where things like the spot ETFs are so powerful. See, the real impact isn't just the new demand they bring. It's that they buy up real Bitcoin, and then, poof, it's locked away in cold storage, basically taken off the market for good. They're like a giant vacuum cleaner for supply, sucking up that tiny 15% of liquid coins and making it even smaller.
Trigger 4. This is where things can get really explosive. A short squeeze cascade. Remember that volatility amplifier we talked about? Well, this is the fun side of it. As the price starts ticking up, all the people who bet against Bitcoin, the short sellers, start losing money. They get forced to buy Bitcoin back just to close out their losing bets, and that forced buying pushes the price up even more, which forces more shorts to buy. You see how it works? It's a massive domino effect.
And finally, trigger number 5. And honestly, this one might be the biggest sleeper of them all, regulatory legitimization. Think about the largest pools of money on the entire planet. We're talking pension funds, sovereign wealth funds, trillions of dollars. Right now, most of them can't touch Bitcoin because the rules are too fuzzy. If we get clear regulations, a clear rules of the road, it would be like opening the floodgates. The amount of capital that could come in would make today's institutional flows look like a tiny little trickle.
Okay, so we've looked at the downward pressure, the volatility amplifier, and the 5 big triggers. But all of this, it all builds to one final, really powerful idea that completely changes how you should look at a bull market. It's not about new buyers showing up, it's about the sellers disappearing.
And listen, if you take one thing away from this whole explainer, make it this sentence. A Bitcoin bull market starts not when more buyers appear, but when the sellers disappear. Think about it. When the amount of Bitcoin actually for sale just evaporates, you don't need a tidal wave of new buyers. All it takes is for the current sellers to just stop selling, to hold on, and then you just wait and see what happens to the price.
So, what does that look like in the real world? What are the signals that the sellers are actually vanishing? Well, here's your checklist. You'd want to see Bitcoin balances on exchanges going down consistently. You'd want to see the supply held by long-term holders going up steadily. You look for those ETF inflows to pick up steam. And of course, you'd be watching the Fed like a hawk for any signal of a pivot.
And what this all points to is a pretty big shift in thinking, a new paradigm. For the big money, for the major institutions, the story is changing. They're not just looking at Bitcoin as some cool new technology anymore. They're starting to see it as something far more profound, a perfect, pristine collateral asset for the entire global financial system. And that shift in perspective, that is absolutely fundamental.
So there you have it. All the pieces seem to be on the board. The theory goes that the supply is incredibly tight, the market structure is built to amplify any big moves, and we have a whole lineup of powerful catalysts just waiting in the wings. The spring is definitely coiled. So the only real question left is, which trigger gets pulled first?